Joining us now to discuss is former Fed Vice Chair Roger Ferguson. Roger, good to have you. Tell me how all of this data is lining up in your mind and what kind of a wage number we need to see on Friday for folks you think to feel like a pause would be reasonable at this point.
Well, look, I think the data are lining up to show that inflation is remaining relatively sticky and certainly above the Fed's 2% stated target. I think the wage number on Friday, to some degree, is not going to be driving these outcomes. I know the market will pay a great deal of attention to it, but it's just one of many, many pieces of data that have come in. And more importantly, therefore, it's important to see the bigger picture, which is that inflation itself is remaining relatively sticky. What does that mean for the upcoming meeting? Well, as you've observed, the odds of a hike in the market's mind seem to have gone up. I think that's a safe reflection. It's going to be a very, very close call. But even if they decide to take a pause now at this upcoming meeting, the market should not interpret that as being the end of this cycle of hiking.
Do you think they can afford to take a pause if Friday's number is hot on any of the reads, given the PCE number that we got a few days ago?
No, if the Friday number is hot, I think it's obviously reduces the odds of a pause. Even if they decide to take a pause, I think they're going to signal it's just to see exactly what the state of the economy is, and a pause is not going to be the end. So I think market should be set up for maybe a slightly more hawkish Fed than had been expected maybe a couple of weeks ago, with either a move or what I would describe as a hawkish pause, i.e. pause just to see how things are playing out, not a pause that's a prelude to an end necessarily.
Yeah, we know all the turmoil from the regional banking situation of the last couple months is still wending its way through the economy and adding to tighter credit conditions, although the full impact has yet to be known. I wonder what you think, assuming we get a debt ceiling deal this week, I wonder what you think the impact is going to be of Treasury having to replenish its cash balance. You got analysts putting numbers out there of as high as $1 trillion of bills that are going to need to be issued by the end of Q3. And Bank of America has estimated that the impact that's going to have on liquidity in the financial markets could be the equivalent of a 25 basis point hike by the Fed. So, again, another area of tightening that perhaps hasn't been fully appreciated yet. How do you see it?
I agree with that. I think there is some uncertainty. As I listen to colleagues, as I listen to friends and former colleagues on the board, as I listen to bankers, I think the question of how much credit tightening is still left in the pipeline is one that's a big question mark. Most people would say thus far we haven't seen dramatic effects from credit tightening. We expect some, obviously. You add to that the possibility of market-driven rates going up as the Treasury goes out to borrow. And so all of that might suggest some wisdom in taking a pause just to see how this credit tightening and higher interest rates play out over the next couple of quarters. So that's one of the things I think will keep the what I'm describing as a hawkish pause on the table. A recognition that more is to come in the credit tightening process. Probably not draconian, but it might be wise just to take a moment to see how that plays out.
I don't know if you've looked at it yet, but the San Francisco Fed put out a report looking at the impact of tight labor markets on core PCE inflation, and actually found in this report today that labor cost growth is responsible for about only 0.1 percentage point of recent core PCE inflation. As we have this conversation about the jobs report on Friday, about how sticky core inflation and services inflation is right now, and that it's becoming entrenched in the economy, is a loosening of the labor market going to be enough to actually bring that back down to a 2% target?
Not necessarily. I mean, I think part of the challenge is the inflation rate appears to be stuck so far above 2% that it's going to be a very gradual and slow process to bring it back down. That's one of the reasons that I have been saying that the markets, I think, have been so disconnected from the Fed in the expectation of a reversal towards the end of this year, towards a loosening mindset. I think this inflation is relatively sticky, certainly above the 2% target. It's going to take some work to get it back down. And the question now is one of tactics from meeting to meeting. But certainly, I think markets should not expect a Fed to take a dramatic swing from tightening to easing. I expect, as I've said several times, for rates to be higher and held longer than perhaps the market has been expecting.